Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Mike Puangmalai. He writes Non-Gap, the newsletter, great Twitter account. He's a master in the dark arts of corporate governance, comes from a background in activism, now doing some software engineering development. We're going to talk to him about what the nexus is between tech and finance right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Mike. How are you?
I'm pretty good. How are you doing?
So, I'm really well, thanks. In full disclosure, we spent 20 minutes chatting. I didn't record it, so we're going to have to get you to do take two. I know a little bit more about your background now, so let me guide the conversation a little bit. You went to USC for your undergrad?
I did. I went to SC, studied international relations and international business. Sounds fancy, but it was really just a great excuse to spend a lot of time overseas studying abroad. Had a great time there. Unfortunately, I skipped out on all the traditional recruiting, so came back without a job, and I've arguably been meandering ever since.
And so you were in government for a little while. How do you describe it? Sorry.
So when I came back, I originally was going to go back overseas to Thailand for a job, but that got rescinded because of a government coup, which is its own interesting story. So ended up actually doing one of my other passions, which was social enterprise and nonprofit, and spent a bunch of time working on charter schools and trying to build businesses that also have social missions. So, today that's pretty hot and it's pretty, on trend, whatever that means. But, back then there weren't many people working on that sort of stuff. And it was really cool. Learned a lot. And, the world of nonprofit is just as interesting, arguably, cutthroat in their own ways, especially when it comes to fundraising as the corporate world. So, actually learned a lot more from that kind of power dynamic, decision-making framework than even I expected at the time. But, did that for about a year. And as everyone, who gets into investing seems to do, they all read about Warren Buffett and the light bulb turns on and you decide you want to be an investor. And, me being as naive as I was at that age, I thought I could just go from nonprofit to investing straight away. So I, quit and then, ended up doing a lot of door knocking and cold emails until I forced this fund in Pasadena, First Wilshire Securities, to give me an interview. And, somehow, some way they gave me a job and I was a deep value, small cap analyst intern for about 6 months or so.
And what era, what vintage is that?
Oh, this was the heart of small cap value. This was
just
like
ripping.
Ripping. Like, we're talking 2005, 2006, where I think anyone and their mom had a hedge fund, and all the hedge funds had just quirky, cool names. And it's funny because back then, small cap deep value had kind of a different meaning. So like back then, in the early 2000s, you could find, these unfollowed stocks that are, they're small, but, they're growing EPS 20%, year over year, and they're trading single digit PE. And literally you're just kind of looking around like, is this real? Like, is this for real? And, it obviously that strategy worked for a long time. So this was very much, the heyday of that style, and probably the most desired type of strategy, I think, at the time.
Yeah, that small cap activism was just red hot. Everybody was a small cap activist on the back of, like, I think Dan Loeb writing the nasty letters, which he says, or Robert Chapman said he got from him, who was another LA based guy.
Yeah.
at the time. But you managed to transition from small cap value into pretty big activism with relational. How did that come about?
Oh, that was so I think a recurring theme of my life and my career is I don't think anyone's actually hired me through the front door of anything. So any question around how did that happen? It was probably because I accidentally or serendipitously, met someone who made an introduction and took a shot on me. And at first Wilshire, so one of the more interesting kind of random observations I've had in life is when it comes to investing is, my background's kind of all over the place. It's kind of eclectic. It's not one of those, McKinsey, Bain, Goldman for a few years and, MBA and just kind of that pattern recognition of what you look for an analyst. I was kind of all over the place. But what I've learned is some of the best, I don't know how they do it. Some of the best investors in the world that I've interacted with just seem to know how to extract the pattern, right? They don't need the pattern recognition per se, but they can kind of suss out and pull out an interesting insight that maybe I didn't even contemplate or I don't assume someone would recognize. And then they're able to kind of build a view of, okay, this person is good for the job or not. And back then, you didn't have much of a choice if you're a PM, right? Like it wasn't something like you can call up, a bunch of you could call a bunch of headhunters, but back then you still had to, it's highly competitive, right? You still had to find talented people wherever they were. And a PM's ability to interview a candidate seems to kind of align with their ability to figure out stocks, just as a random aside.
So just for folks who don't know, relational closed down about 2014-15, but they had raised some backing from CalPERS, were sort of a contrast to many of the louder forms of activism at the time, sort of more constructive behind the scenes, probably more listed private equity rather than that sort of just sell yourself or pay out the money or we're going to embarrass you until you do the right thing. So what was your experience at Relational, and is that a fair characterization of who they were?
So Relational, you could probably break up Relational into different eras. So they started in the mid 90s as part of kind of a CalPERS initiative to get more investing, governance-centric investing into the market. So they had their focus list, CalPERS did, and they wanted to kind of elevate that into a more, productized investment type strategy. And they seeded a bunch of funds. Relational was one of them. So early on, a lot of the agenda and activism was kind of event driven in the sense that, you're talking mid 90s. There were a lot of companies that had the classic good business, bad business model. And you can literally, all the money was made in one business. All the losses were in another, spin it off, stop it, literally very basic strategy, but they were all over the place. So I would say a good chunk of, Relational's early years were tied to that kind of investing in agenda. Now they were probably more in your face back when they started, but over time, the strategy got arbed out, right? It's even today, it's not like you can find a company that has, just this conglomerate discount where you do
there are a few of those around.
Well, there is, that's true. I laugh because it's a running joke, like don't come in and pitch a sum of the parts discount to a fund, but Relational is probably one of the few places where you can get away with that because you were the catalyst, right? Like you were the one that actually you can pitch that here because we're gonna be the ones that work with them to try to unlock that value. So that was very much a traditional bread and butter type strategy for a long time, but to kind of complement that, we try to work with companies behind the scenes, right? Help them with their investor communications, how they kind of convey the story to the street, how to think about capital allocation, all the kind of good stuff that investors are looking for when it comes to management teams and disciplined capital allocation. We try to work with them behind the scenes.
Your note on Relational has these two nice charts in it that very similar to something that Buffett has said in the past. But basically, there's a return on invested capital and a growth rate that justify these sort of valuation multiples. And if you're sitting outside that sort of optimal point on the structure, you shouldn't be growing. You should be trying to do something else. You should be trying to pay out some capital or sort of right size. Was that sort of the way that Relational thought about those positions before they went in?
I think that's a fair assessment. I think if you were to kind of capture like what is kind of an overarching concept that we're trying to think about, it's that friction between growth and return, right? Like if you over optimize for return, you're not properly investing in the company. You're potentially killing your innovation pipeline, which hurts you longer term. We don't want you to do that. If you chase growth, or if you over optimize for growth, you get to a point where you get into these highly dilutive transactions that destroy a lot of value, and suddenly the market begins to assume, well, if you're going to keep burning money and doing bad deals or chasing bad R&D projects, we're just going to assume you're going to do that, project it out and apply a discount to that incremental capital allocation. So the friction is what is the right balance there, right? And I would say the market is generally pretty forgiving up to a certain extent, but if you start doing, if you're an executive and you're running your strategy, you're trying to prioritize highest and best use of your capital, you can get away with risk. You absolutely can, and sometimes the market will actually forgive you on a few bad deals, but at a certain point, if you're doing bad deals and there's just not a proper framework in place to kind of justify, the risk you're taking on, the valuation starts getting a pretty, punitive, multiple. And our job, at least at Relational, was to go, listen, we're not experts in what you're doing and what you're prioritizing. So, work with us, help us understand what you're trying to do. And where we can be helpful is we can help you, communicate how those priorities are important, or on the other hand, we can also, put together kind of an investor communication program that helps, the market understand what you're trying to do. On the other end, if we try to, figure out what's going on and we just kind of recognize, no, you're just actually burning capital here, we're going to insist that you stop or try to reassess how you want to do that. Otherwise, taking kind of the ownership's perspective as a shareholder, we'll seek board representation. And if we can't figure it out from the outside, then maybe we can work together from the inside to come up with a cohesive plan.
And did you you've got this great series which we're going to go through in a moment on your blog about corporate governance and the dark arts of corporate governance. Is that the basis for that series? Is that where you learned about the dark arts of corporate governance?
It's an interesting question. So when I started at Relational back in 2006, I would say the first, and at the time, I didn't really enjoy it. Like, I don't think anyone enjoys reading a proxy. If they tell you they enjoy reading a proxy, they're either lying to you or I haven't met you, which is kind of weird because I'm probably the only person that likes reading proxies at this point. But
there are a handful of folks, right? Once you read them and you start finding where all the little tricks and traps are, they start getting a little bit more interesting. But they're hard to read cold. But that's why I think your series is so good.
So the first 4 years at Relational, I would probably say 80+% of my time was reading proxies, going through governance. Trying to understand, incentive structures and, literally doing comps and doing all that. Now, in hindsight, that was a blessing, right? It was one of those things where it actually, helped me, as an investor longer term. But at the time when you're, 20 something years old, you're starting your investing career, you want to build financial models. You want to value stuff, right? I want I want to build the Excel breakup model in this company. Like, why am I looking at proxies? And to keep myself entertained, at some point, like, you're going to go crazy reading a proxy. If you're right, like if you're reading a proxy, like just for the dryness, you're going to go crazy. So eventually, like, you start to realize there's a whole narrative behind what's going on and what's getting expressed in those filings and in those governance documents. And it really doesn't get hammered into you until you actually go on to these boards. And so, at Relational, when we go on a board, we have board representation, but someone like me would be completely in charge of going through every board document that, would be given to the director, and to break down and do an analysis and to kind of understand, like, what are, from a board level perspective, what are the priorities going on at these companies. And as you kind of like understand how, organizationally, how companies operate and how they're governed, you start to realize kind of the intersection and the relationship between what you're trying to prioritize as a business and how you want to allocate capital, and how that gets expressed in the incentive structures and governance. And at least after 4 years of doing that, you begin to realize, oh, there's a story to be told here. There are subtle adjustments that people make when good news is on the way. There's subtle adjustments you can make when bad news is on the way. There's subtle adjustments you can make to retain talent. I mean, there's all sorts of different tips and tricks you can do, and what you learn is, as a board member, you can't really do much to drive change, in the organization. So there are only so many levers you can use, but those levers are very powerful. They're really powerful because you change an incentive structure on a management team, you'd be surprised how much change occurs within an organization. It just cascades down. It's almost, it's almost, I mean, it leaves me speechless sometimes. Like, wait, you're telling me if I just change the compensation hurdle from, like, say, revenue growth to a blend of, revenue growth and ROIC, that this is actually going to change, like, priorities in an organization? And the answer is yes, it does. And it's remarkable. So, using those experiences and realizing that, proxies are probably one of the last few places where, boards kind of express their intent and management teams, express who they are. It becomes a very interesting, source of reading, but also a source of understanding, what is the true story of this company, right? Like,
I love your approach to it, where you say that reading these things is very dry, but if you understand the dark arts, you understand why things are being done, then it does become much more interesting, and you can sort of dig through to find the story. And you say that they're dark arts because compensation can be used to distort the alignment of incentives and can be used to control what goes on in the company. And you've got the great story about Ben Horowitz and the option backdating scandal. Do you want to tell that story?
Sure. I mean, so I think one of the recurring themes you'll come across when it comes to governance or even decision making at the highest level. So, like, I focus on governance because I find it interesting, but I think this is just decision making in general at a lot of these companies. What you'll find is, more often than not, you'll come across a situation where the correct answer isn't, straightforward. It's not black and white. You might even feel uncomfortable, and from a kind of moral dilemma or ethical perspective. And more often than not, the pushback or the response you're going to hear from someone is, well, this is best practice. This is standard practice. This was signed off by the lawyers, the advisors, X, Y, and Z peers do it. And that makes it okay suddenly. And I think, the Ben Horowitz story is basically, and obviously this is secondhand because I'm just going off the blog he wrote, but he talks about a time when he brings in, new leadership, and from a kind of competitive retention perspective, this person recommends more or less options backdating, right? This is a way to incentivize and keep employees motivated because their strike prices will be based on some lower price backdated than when they actually granted. And at the time, the argument was this is signed off by everyone. The industry does it. It's okay.
PwC blessed it, I think, in that particular instance.
Bless the accountants who sign off on these things. So what he did, and like you come across this all the time. He said, you know what, like this sounds great, but let me talk to my general counsel on this and see what he thinks. And what ends up happening is the general counsel who Ben kind of describes as kind of this strong moral backbone, really kind of like I think he was like a Berkeley based, very like values driven guy, and he was like, I've looked at this every single angle I can. I just don't think you can do this. I'm not signing off on this. And Ben, and this is a great lesson for a lot of people. Like, make sure you have that person or that voice you trust that's willing to be the straight shooter and tell you how they think it is, and you trust him enough where it's like he doesn't have an agenda, he believes in this, and it's it's great. Ben had that resource, and they ended up not doing the backdating, and saved them a lot of trouble. And it's interesting that it was the general counsel that does it, because when a lot of times when you get into the dark arts, or just kind of fluid judgment within governance, morally fluid judgment, odds are you're going to run into a general counsel that made the call to sign it off. And that I always joke that there's always one fixer, or there's usually a lot of fixers within these corporations, and more often than not, like, the general counsel is the fixer and gets stuff done, both good and bad. But
he had an interesting construction, because the general counsel reported directly to him rather than through the CFO, and it was the CFO who was recommending this particular option backdating, blessed by PwC and standard practice in the industry. And ultimately, she went to jail for something that had happened at her previous employer, where they had been using this for 3.5 months. And they missed it because they didn't implement it. So it's kind of like, I read that and I was kind of shocked. I didn't realize that folks actually ended up going to jail for that. So it was kind of shocking. But it kind of reinforces how important it is to get to understand that it's more than just a box-checking exercise, and there really is there's some nuance to reading these things, which you seem to have done really well. So you talk about using compensation. The two mechanisms are spring-loading options and bullet dodging. And then there's this great part in your note where you say, this is why we use, so you illustrate it all through case studies. And you say the reason we use case studies is because there's, I'm gonna mangle what you wrote, and folks should go and read it because it is so great. But you say that there's some of these things are so nuanced, it's impossible to kind of articulate them. The way that you have to learn about them is just by doing lots of reps, reading lots of case studies, participating in them too. And the two examples you give are sexing chicks and World War II spotting. Do you want to tell those stories?
So, I mean, this is my personal opinion when it comes, you can probably, mechanically get, a lot of the spring loading and bullet dodging dynamics down, but, compensation analysis is very mosaic theory type approach, where you kind of have to blend what is the investor perspective, how is management thinking about this business from a strategy, execution, operations perspective, and then blend it in with governance and blend it in with compensation. So kind of going back to sexing chicks, or recognizing the right bombers are coming in, to really kind of, at least for me, learning to really kind of appreciate what is signal versus what is noise. It really comes down to recognizing when are these grants truly telling you that there's some bullishness or bearishness going on, and the only way for me to learn that was to literally research the companies, do fundamental analysis, do all the things that, all the investors do to try to understand, the company and the value opportunity there, and then take that experience and then blend it into how do you incentivize management teams to do what you think is necessary to execute. And so that dynamic is kind of open-ended, right? Like if I were to ask you, okay, you're the board member on some company, you want to incentivize or reward management for certain things, what can you do? And the answer is very broad. And so when we talk about sexing chicks or recognizing the sound of bombers, it's literally like you're taking at bats and you're looking at pitches, right? It's almost teaching someone to how to recognize a curveball. It's like you can explain it, but best way to do is like get in the batter's box. I'll stand from the umpire's view and like throw the pitch. Like, what do you think that was? Like, oh, that was a fastball. Okay, what's this pitch? Oh, that's a curveball. And so you get this dynamic where it's like, okay, now you recognize what the pitch is. Can you anticipate what the pitch is? That's a little bit harder, right? That requires a little bit more mentoring, where it's like, okay, well, what kind of pitch do you think if you get a 2-0 count? Well, they're probably not going to throw a curveball. It'll probably be a fastball. And it's that anticipation, that kind of in-game, situational awareness that requires a little bit more training. Or at least for me, it required a little more training. So when you look at
it's too subtle, right, to articulate it. You have to, with sexing chicks, you can't tell somebody what to look for. They just have to guess on the first few, and then after a while, the apprentice understands it, with the master standing over their shoulder saying, that was wrong, that was right, that was wrong, that was right. And after a while, they get this, they can understand what it is they're doing, and they're getting it right more often than not, even if they still can't articulate what it is that is the difference between one and the other. I just thought it was a fascinating kind of example.
Yeah, I think, at a certain point, and this is where, when people ask, well, how can I get better at this? It's like, well, what industries are you comfortable with? Okay, we'll start there and start looking at those compensation programs. And over time, you'll start to kind of connect, how you're familiar with the strategy in the business with how they're compensating people. And then you start picking up, different nuances like, oh yeah, the stock's struggling because there's expectations that demand's going down, but all of a sudden they move grants up 6 months, and it's like, why would you move grants up 6 months on compensation? I thought demand is weak, and then you realize, no, the stock is pricing in demand is weak. They just told you that
there's something
demand's
coming.
There's something probably not as weak as you think, and so you kind of bring it together. And in hindsight and after the fact, it's easy to explain, and with the hope that, okay, eventually you can start picking this stuff up in real time, because if you do it correctly, and this has been true even as I openly talk about this stuff, it's, for whatever reason, it's still true. You will find situations where stocks will just pop 10, 20, 40, 50% on this sort of stuff, and it's hard to kind of take a systematic approach to it, at least for me. But you identify a handful of those situations every year. I think it's fair to say your portfolio is going to do fine. Right?
So you give the example of TPG and J. Crew, and you say the first thing that TPG often does is they chair the compensation committee. And then you look at the equity. The key thing is equity grant dates, and you have this great analysis on it. Do you want to take us through that example?
We can't have a podcast without talking about TPG. So, kind of going back to my early years at Relational, just kind of talking about looking at a bunch of proxies. So, it just kind of backstory. Relational takes a very concentrated approach to the portfolio. So we might only hold like 8 to 12 names across 2 funds. It's very concentrated, which means for me, I might only get maybe 1 name into the portfolio a year if I'm lucky. There's a lot that ends up on the cutting room floor, right? Like there are a lot of stories, a lot of situations that have never met the light of day. And the funny thing is, TPG and J. Crew. I mean, this was 2010, 2011, right? This was years ago. I mean, That was one of the situations where I just, observed, from relational, saw what happened in the proxy, and I thought it was fascinating, right? Like I like to joke, like that's when my eyes, years after, being a relational, that's when my eyes really opened as far as what this stuff was all about. And using the seat of compensation committee chair to help shape and influence not only what a company does, but also potentially use it as a way to encourage or influence a deal to go your way. It's a very powerful realization when you figure it out, and it was like from that point on that I was like, okay, I need to keep track of these guys and study these guys, because clearly they know what they're doing, and B, they're willing to push the envelope a bit. I'm not saying they're doing anything wrong or illegal, but like you do enough of these things, you start developing a list of folks and organizations you should probably keep an eye on, because at some point they're going to give you an opportunity to participate alongside. So
you point out that they were very good at timing their option grants. So it's a good example of spring loading, that they'd make a grant and then often there'd be an event that occurred after the grant, like in very close to the grant, where they'd get this pop in the price. But making equity grants seems to be a grey area where you're allowed to do that, because the SEC investigates one of the guys who seems to be aware that the buyout of J.Crew is coming up, and he transacts on that basis. But there are equity grants around the same time that don't attract any attention at all.
It's funny, isn't it? Like there are very clear, stringent insider trading laws, and even companies have very clear insider trading policies, but they don't have insider equity grants is for whatever reason one of those categories and topics that just don't really doesn't get much scrutiny. And there's a lot of, like you said, there's a lot of gray area. And just kind of going back to that J.Crew example, J.Crew, their compensation granting policy was pretty much, we'll grant you equity on, I'm going off memory. I think we'll grant you equity on the 15th of the month. Like, so if they approve a grant, it gets granted on the next month on the 15th. So if you actually have visibility that, hey, they're going to kill earnings pretty soon here, we can actually approve grants that will be granted out on the 15th of the month, right before earnings. And so, like, literally, if you're to study the grant patterns at J.Crew during that time, that's literally what they did. It was like, if there was good earnings on deck, they granted earnings. They granted equity right before, and it was like clockwork. So going back to that SEC investigation, I mean, I think this was 2009.
Yeah, it's a 2009 one.
2009. So they granted equity, I want to say like April 2009, which I think anyone who was around that time, I mean, this was the bottom of the market in general. And they granted equity only to see, the next earnings was, I think, May, where the stock popped 40% on earnings because they had really good numbers. Around, like as you mentioned, around the same time, a J.Crew, I don't want to say a J.Crew executive, but someone high up who had access to the same numbers did a transaction knowing that the numbers were going to be good at earnings, and they got caught, right, by the SEC. But to your point, it's funny because the compensation committee and the board saw the same numbers, decided to grant equity on that information, no problem. A manager sees the same numbers, tries to do an options trade, you're getting banned, you're getting barred by the SEC, you're settling, you're paying fines, and the only difference is he tried to buy, equity, whereas a compensation committee approved this equity grant. And going back to kind of our conversation, that equity grant was signed off by general counsel, by all the advisors. It was okay. It's legal, and same information.
You've got a similar story with stamps, and I think the takeaway is play the man, not the cards.
Yes. I mean, over time, going back to kind of the recognizing the sound of engines and sexing chicks, who knew that would be a theme of this podcast. eventually when you look at enough of these situations, and I'm about to violate my recommendation of mosaic theory and focus on industries you understand. Eventually, you just kind of recognize behavior, right? Whether it's stamps or I think more recently I did one on Vaxart, which was a biotech, and I don't cover biotech, but at a certain point, you just kind of recognize behavior, and you recognize some decisions or some grants just seem out of place, and it becomes a game. Like, it's, if you're really good at poker, and I'm terrible at poker, you can to a certain extent start reading reading the man and not the cards, where if you kind of understand what they're trying to do, and kind of the tells and the quirks of that decision, you can just start drafting off of that decision making. It's not perfect all the time, but you can definitely nail the intent of some of these grants. And the point being is, I might have no idea what's going on in this industry or what's recovering or what's improving, but I can recognize someone who believes something good or bad is about to happen here, right? Like, you see a guy goes all in, like, assuming they're a very amateur player, you can kind of tell the difference between if they're trying to bluff you or like, oh yeah, they got pocket aces. And governance is a lot like that to a certain extent, because at the end of the day, people just can't help themselves sometimes.
You've got the third example is the Green Sky, the busted IPO. What's Green Sky do?
So Green Sky is a fintech company, which I think anyone who covers fintech immediately kind of rolls their eyes when you see a fintech company with a growth multiple. Look out. But Green Sky helps provide loans to consumers who want to do home improvement projects. You want to put on a new roof. They provide kind of the ability for these contractors to offer these loans to consumers to help kind of fulfill or help pay for that project initially. And as a consumer, that makes sense. I mean, I had to replace a roof recently, and I couldn't take out a home loan to do that. I was like, oh man, I have to take out cash and pay for it myself. So I was like, okay, this is a useful product. The challenge is fintech and how to fund these businesses. These are very difficult businesses to operate, right? From a funding, growth, risk perspective, and you're balancing all these things. And as you kind of deal with this dynamic of trying to fund these transactions, Green Sky trying to fund because they have to get money from somewhere to fund their loans. You get into situations where if you lose a deal with one of your financial institutions, that's going to hurt the stock, right? Because that implies you can't hand out more loans, which means the stock growth is going to slow down, and you might have to take on a different lending source with more punitive terms. It becomes kind of this a spiral. So Green Sky, I think when you look at ever since they've gone public, it's always been kind of this dynamic of trying to pursue this greenfield opportunity, while kind of dealing with the realities of financing operations. And when you kind of study the challenges of that, you start to see that, okay, well, this thing's a busted IPO. You're the leader of this company. How do I get my people incentivized, right? Well, you're probably going to give them retention grants at some point. Okay, well, I know I'm going to have to give them retention grants. When do I give them retention grants? Well, you probably want to give them retention grants when you have good visibility on something positive is about to happen, right? And there's nothing wrong with that. I think that could be good practice for the people that you value in your company. Well, if you're going to do that, I mean, hypothetically, if I'm CEO and I want to keep you, I'm gonna go, listen, I know the stock is messed up, but I think we're about to turn things around. We have some really nice things on the way, and you'd be aware if it's like, let's let me grant you some equity. to keep you around and keep you incentivized, because I know your grants from the IPO are underwater. I mean, this is kind of, just kind of qualitative, like, conversational type. I mean, you can envision this conversation happen over and over again in corporate America. And you do it, right? But if that's the dynamic from the outside, you're like, this is a busted IPO. They just gave retention grants out of the blue. They're talking about, these priorities that they need to fix. It's not perfect, but there might be an opportunity here to trade alongside this situation.
And you gave that as an example of you can't manipulate the strike, but you can manipulate the number of target shares that are issued.
I'm starting to realize you can actually manipulate the strike, but that's a totally separate company. There are ways to so just kind of, I guess, first principles. When you're doing equity compensation, normally what companies do is they come up with a target value for your shares, and based on that target value, then they determine how many shares to give you based on the grant date price. So if your target's $1 million and divide by the grant date, there's a number of shares. In the case of a place like GreenSky, there's actually a lot of flexibility as far as when you want to determine the share count. So in the case of a company like GreenSky or anywhere else, let's say your target value is $1 million, but you also know that you have good news on the way. Well, the stock is trading at $5. Let's use $5 to determine the number of shares to give you, and then okay, now that we've locked in the number of shares, we'll officially grant you the shares after the good news comes out when it's $10 or $7. And so it's a very subtle, quirky, decision to do it that way, and you don't figure it out until after the fact, until you can't figure that out in real time. Like I wouldn't be able to figure that out. But come proxy season, you see how they do the incentive structure and the calculation of shares. You go, oh wow, that is one way to kind of juice. You can get an extra 20% of shares by doing that way, and you can't trade on that information. But the lesson there is, depending on who is on that compensation committee or who made that decision, you lock that away for future reference. Now going forward, people affiliated with that company or that committee might be compelled to do certain things at other places. So you start seeing that pattern recognition of when you start seeing dark art style decisions at one place, it doesn't stay there, right? You go, you're on the board of multiple companies. You're going to suddenly make a suggestion, going back to the Ben Horowitz comment recommending backdating. It's like, oh yeah, we did it at my old firm. A bunch of companies do it. PwC signed off on it. We should do it here. And it's the same dynamic happening right now with spring loading and bullet dodging and these kind of quirky, calculations.
The practitioners of dark arts, you follow the practitioners. And so I guess one of the takeaways is you got to look for these out of cycle equity grants. That's kind of a pretty good signal that maybe there's something coming.
Out of cycle, or I don't even actually look for out of cycle. I like looking at situations where there's a massive sell-off, because in general, when there's a massive sell-off, there's a lot of focus at these companies to turn around the operations, to kind of focus and right-size priorities and strategies. This is fundamental analysis 101, right? Complementary to that, refocus is you also reassess how you want to compensate your team for this kind of new go-forward plan. And so when you have a dynamic where you see a massive sell-off, that intuitively they're going to want to make changes to their operations, because listen, anyone running a company that sees a 30-40% trade down, they're going to make changes. Like it's just even if you have conviction on the strategy, you have to make changes because your shareholders are yelling at you and you're feeling the heat. So you take that dynamic and then you realize, okay, there's off-cycle grants going on in addition to the sell-off. That they're going to be incentivized to make sure the grants are more around the time of the turn than no one's going to grant equity into a falling knife, right? Like investors, we have to take that chance. We hit a falling knife. You're not going to grant equity and then pull the Band-Aid and reset expectations to cause the stock to obliterate another 40%, right? You're not going to explicitly do that. You might do it after the fact because that's just the dynamic of the situation, and things got worse than you expected, but you're not going to voluntarily do that stuff. So when you're looking at off-cycle grants, the first thing you should ask is, what is the fundamental business case for why the company would be bullish to grant around this time, right? And from there you can kind of figure out, okay, these are very interesting or not.
Let's change tack a little bit. Talk about DoorDash. Got an IPO potentially coming up here in the near future. Food delivery is a really tough business. Food delivery sucks, as you say. But they figured out some interesting wrinkle with the service fee and tax. Can you explain what DoorDash is and what they figured out?
Yeah. So the funny thing about starting the Substack is I've learned it doesn't take too much to become a topic expert in things, apparently. So now I'm a governance and food delivery guy. But DoorDash is a funny story just because. So food delivery sucks. And full disclosure, so after Relational, I actually worked at a long-short hedge fund called SQN up in San Francisco, and probably my top idea there was to short Grubhub. And the thesis at the time hasn't really changed all that much as far as like, hey, you have these really punitive kind of commission rates, 20, 30%. Restaurants are already kind of razor thin margins. This is very difficult, like unsustainable type unit economics. And it's, kind of put it all together, Grubhub's overvalued. And this was, I want to say 2015. Obviously I ended up kind of changing my mind. This is kind of one of those stocks that I've, at any given time have been either incrementally bearish or bullish, depending on the impact. But it was a formative kind of experience to kind of study the space. So fast forward, to today, DoorDash, knowing that the economics of this business can be very, very brutal, just kind of studying someone like Grubhub, it was always interesting to follow those guys or even Postmates and just see how they got by. And DoorDash, one of their innovations, I don't know if you want to call it an innovation, but they're the ones that kind of brought along the notion of a service fee, right? Your 10%, the Twitter meme, like you're ordering a $10 burrito and the service fee is $20. Like they kind of introduced that concept. And part of the reason they brought it, they introduced it was, before you could just mark up food to kind of make your margin, and then lawsuits and consumer complaints happen. So they, as a form of transparency, they pulled it out into a service fee, where things, I guess, got quirky. And what actually, kind of caught my attention was to make the food delivery economics work. Like there were only so many levers, and if you're not taking commission from a restaurant, which if for a lot of DoorDash's deliveries they weren't, like how do you actually fund these deliveries? And there were kind of two levers that I figured out, and the only reason I only figured it out was I was a big DoorDash order person, and I used to, like if you ever wonder why I'm so knowledgeable of food delivery, it's because one day I realized that DoorDash was doing this very aggressive gratuity tipping scheme, and I felt taken along for a ride. It's like, how dare you use my tips to subsidize these rides? And I think I wanted a $12 refund for my tips, and they wouldn't give me the refund. And out of curiosity, like, this is weird. Like, you won't give me a $12 refund? Like, this isn't like a normally you deal with Domino's or Grubhub, they'll just give you a refund. It's not a big deal, but it's like, you won't give me a refund? What's going on here? And literally that led me down the rabbit hole to figure all this stuff out. So if DoorDash is wondering why in the world I wrote about them, it's because they didn't give me a $12 refund.
Let that be a lesson.
But what you learned is, the levers to, and they changed their gratuity policy. So back then, even I want to say even a year ago, what would happen is, they tried to make the income drivers earn more stable, which I think is a great idea. The challenge is how do you implement it? And the way they implement it was, we will guarantee you, some amount, $5 minimum. But if you end up getting tipped more than the $5, then you're really only just getting the tip. But if the customer isn't tipping, then you get the $5. It was they gamified it in a way where they knew how much the tip was up front, but they kind of gamified it where it's like, we promise you at least $5, knowing on the back end that the tip was going to be $8 or whatever. So that was a big deal, because if you can reallocate delivery fees and those dollars to other deliveries, right, it's suddenly you have just much more sustainable unit economics, which they were able to kind of help drive their growth. And for them it was the right decision, right? I don't know where they're at right now, $15 billion valuation. Like they literally, if you lined up when they started doing that with their valuation, it was like they went from $1 billion to $15 billion. A lot of it on that, but they've had escape velocity as well. But the other lever they use was sales tax, right? Like and how do you calculate sales tax? And this is actually one of those like unsettled things. Grubhub will charge you sales tax on all your fees, more or less. Delivery fees, service fees, the cost of food. They're gonna, in California, it's like, I think it's like 8 to 10% sales tax. They'll apply it for everything. Someone like DoorDash will only apply it to your food. I don't even think they apply it to their service fees, if my memory's correct. So there's actually, depending on the order size, there's gonna be, up to, it could be 50 cents a dollar delta on some of these transition, head to head, same restaurant, same order between a Grubhub and a DoorDash, and that delta in savings typically was enough for them to squeeze in their 10% service fee, right, or whatever service fee they had in place. Versus at the time, Grubhub doesn't charge. Well, they charge one now, but at the time they didn't charge a service fee. But somehow, some way, DoorDash was always competitive with Grubhub on these orders. And part of it was, how do you treat your sales tax? And if you treated it a little bit more differently, you can get away with charging a 10% service fee and having, the same out-of-pocket costs versus Grubhub, who didn't, because they were collecting a commission, from the restaurant. And it was kind of one of those things where it's like, whoa, that was really interesting. And I think there's still, it's still a little bit of political football for DoorDash. And, especially with kind of COVID-19 happening, it's like there is, if assuming Grubhub's approach to sales tax is correct, there is potentially an argument that the largest sales tax evader in San Francisco might be DoorDash during this COVID-19 stay-at-home brouhaha. Like, I don't know if that's the case, but like it just depends on how you treat that sales tax. But you can see how this could turn into political football very quickly. No different than drivers are employees and all these other quirks. So I don't think they're necessarily out of the woods with this arbitrage that they're still doing. But there's a saying that I have where people kind of celebrate fake it till you make it. In the startup world and a lot of these kind of grayer decisions, it's kind of a dynamic of scale now, settle with society later, right? It's like, yeah, okay, maybe this isn't the correct interpretation, but we're now a $15 billion company and we can settle it for less. And for them, that's the right economic decision.
Something like the Uber model, where they just do it and then try and after the fact they'll just figure it out.
Well, they'll figure it out, or they'll settle it, or they will work with the regulators to come with the right resolution. And listen, like Uber, to break up kind of the hold the taxi industry had on all these cities, it took a little bit of moxie and vision and a willingness to take that risk. That okay, once customers get used to pushing a button and a car shows up, that's not going away, right? Like you can try to regulate that or say like rideshare is gonna be hit hard or whatever, but you're not going to take that fundamental feeling of being able to open your phone and have a car show
It's
up.
the superior experience. There's no doubt about that.
So now it's like, okay, well, yeah, they ignored all the laws and they screwed over the taxi industry, but here we are. They're not going to go away, so we're going to have to settle. And that was probably the right outcome, in hindsight.
Yeah, I love it. I love all of the. I learned a lot reading through those posts of yours, and I'll make sure I link through to all of them in the show notes. But you've got this. I just wanted to leave it on this final point. You've got this great. You got the great Pablo Picasso quote about turpentine. Do you want to give it? Do you remember it?
So I love making Picasso references. Only because when people look at his paintings over the years, we're all inspired, or we love looking at his art. But like when you think about kind of his history, it's like when he first got started, he painted like you would think someone paint, just like lifelike, very specific, very real paintings. And over time, he took a lot more creative license on what he was seeing in his eye and expressing things. And I always loved that kind of, that quote he talks about, when critics get together, they talk about form, structure of these paintings. When artists get together, they talk about where to get the cheapest turpentine. And the point being, you have critics and observers who are trying to apply, very rigid checklists, structures on how things are supposed to be, and the artist isn't constrained necessarily to the rules, right? They just want to keep doing what they're doing and express themselves and do their art, but their limiting factor is turpentine. It's the building blocks, and governance in a lot of ways. When you study like these decisions, it's I'm not going to say it's art, but there really is something to be said about your casual observer, the ESG person who's trying to checklist best practices and what's right, and what's the best way of doing things. And the reality is, the real practitioners of governance, they're kind of artists. They realize there's a lot more gray area here. It's not necessarily right and wrong. I mean, there's arguments that things are inappropriate, but it depends, right? If you're staring into the abyss as a company and you need to keep people motivated and get certain things done, that's a tough dilemma, right? And it's kind of that the turpentine is the grants, the equities, the incentive structures, how you want to bring in people and rally them around something. So I've always kind of loved that quote as far as how to look at these things, right? Like when you achieve, I guess this is kind of my last thought, but when you achieve a certain level of expertise, you're genuinely given kind of two choices. You can either be a critic because you're the expert, what's right, what's good, right? So you can criticize, or you can evangelize, right? You can try to make it a little more accessible to people. Celebrate it. Don't be a gatekeeper and discourage people or criticize people because they're trying to do something. And that's, at the end of the day, kind of what I'm trying to do with writing about governance is, I know this stuff. I could have been a critic. Like
you could be a dark artist too.
I could be a dark artist, but I want to evangelize, right? I want to kind of share and show people like there's some interesting things here, and you can learn a thing or two, not only about governance, but at the end of the day, it's a reminder that these mindless companies, from the outside they look like these mindless kind of machines, but they're people pulling the levers behind the scenes. And just remember, they're pulling levers. They have their own, behaviors, aspirations, fears, interests, and they get expressed, through these companies.
Yeah, it's absolutely fascinating, Mike. If folks want to follow along or get in contact with you, how do they do that? And make sure you mention your Substack.
Yeah, so I guess I'm on Twitter a lot. My username's nongap, and NONGAAP for the non-finance accounting people.
Great Twitter account.
Yeah, I also own nongap.com, which is why I chose nongap as my Twitter handle. And then you can find me on Substack, so I think nongap.substack.com. Yeah.
Well, thanks so much for spending time with me chatting about this stuff. It's absolutely fascinating. Mike Puangmalai, non-gap, thank you very much.
It was a pleasure.